Howdy, Jacob here. Today we're looking at Boyd Gaming Corporation in the hotels, restaurants, and leisure industry. 5.1 billion market cap on 7.6 billion enterprise value. Growth is fairly impressive. You're looking at low to mid single digit year-over-year revenue growth with gross margin increased and operating margin increased. Very high margins. 27% on the operating side is extraordinarily impressive. Return on invested capital recently very high. 10%, 11%, 12%. It's pretty great. Balance sheet shows 304 million cash on hand, 44 million short-term debt, 2.8 billion long-term debt. All right, so that long-term debt is a slight concern, but we'll see what that is in relation to cash flow to see if we're really concerned about it. So if we look at an average of the last 3 years or the last 5 years, we're looking at about 500, 600 million. That's a good amount of their long-term debt, but not something to be like really scared about. Maybe 5 years roughly of their long-term debt, which is not a huge concern, but that means they are going to have to allocate a bit of their capital towards their free cash flow allocation to go towards debt. And a lot of their money recently has been going towards share repurchases. They have a dividend of 1.27% yield, and that is maybe 15% of their free cash flow. So that's not really a big concern. Um, Otherwise, a little bit of acquisitions. So we're going to have to again allocate their cash flow in a projection based model on what we think they're going to do with what they've done historically. And so I think that with 5 year average or with 5 years of their free cash flow in long-term debt, they're probably going to have to allocate 20% of that free cash flow to debt reduction. So if we start making some assumptions here, I'm going to stick with a low single digit year-over-year growth, maybe 5%. Let's go mid. Margins are higher recently. Let me look. There was an acquisition right there, 2020. Okay, maybe that's it. I don't know. But margins are a bit higher recently. We'll see whether that can stick or not. I'll probably go on the lower end of the recent side. So maybe let's do 16 and 14. Share repurchases, they've been buying back a lot because 1% would be about 50 million. Offset stock-based compensation about 80, 2%, 3% would be 120, 150. I think I'm good with that. So that's 150 million of free cash flow going towards share repurchases. Their dividend, we'll keep that the same. They don't need to increase that, paying out about 15%. So we're pretty close to about 50% of capital allocation. That leaves about 20% towards debt reduction, 30% to make acquisitions, reinvest to keep these type of margins and get a 5% return. So on the PE side, I mean, their enterprise value is a bit higher because they have a bit of debt. So let's go a little bit lower than market average here. And we're actually saying that it's buy right now. So this could be an interesting company. I'm going to have to do more research on it to see whether I think these projections hold or not. But honestly, if you do your own research here, see whether these margins really make sense or not. I think if they're able to keep these margins and the company focuses on paying a little bit of capital allocation today for the next couple of years to get down to maybe 2 to 3 times their average free cash flow, then I think this could be, they have enough capital allocation to really buy back shares, make some acquisitions that could be advantageous. Yeah, so I'll be doing more research on this hopefully soon. I hope you enjoyed the video and have a great rest of your day. Thank you.